In the next few months, decisions made in quiet conference rooms could determine the price of food in American grocery stores, the survival of auto plants across the Midwest, and whether energy stays affordable through the next winter. That's not speculation. That's what's actually at stake in the trade fight now unfolding between the United States and Canada. And almost no one is paying attention to how unusual this moment really is. Because for the first time in decades, Washington made 5 major demands of Canada and heard the same answer every time. No, this confrontation didn't begin with sanctions or speeches. It arrived disguised as routine paperwork, buried inside the scheduled review of North America's most important trade agreement. A process that usually runs quietly suddenly became a test of power. The United States laid out 5 conditions it said must be met if the agreement was going to survive long-term. What followed wasn't negotiation. It was something closer to a recalibration of reality. The agreement binding the United States, Canada, and Mexico is more than a trade deal. It's the operating system of the continental economy. It governs how cars are built, how energy flows, how food moves, and how digital platforms operate across borders. When the United States Trade Representative, led by Jamieson Greer, presented Washington's conditions, the message was explicit. Stability would come at a price. Access would be conditional. Canada would need to adjust core parts of its economy to align more closely with American priorities. Historically, that approach worked. Canada depended heavily on access to the U.S. market. Pressure usually produced compromise, but this time the response was different. Mark Carney reviewed the list and rejected every demand, publicly and immediately. No delays, no diplomatic hedging. That single decision changed the tone of everything that followed. This stopped being a technical review and became a test of how much leverage each side truly holds. The first demand went after dairy. Canada's supply management system limits production, stabilizes prices, and protects domestic farmers. American producers have long argued it blocks fair competition. Under the current system, U.S. exporters can sell limited volumes tariff-free, but anything beyond that threshold faces tariffs that can climb above 200%. Washington framed this as protectionism. Ottawa framed it as food security and rural stability. When Carney responded, he did so in French, deliberately signaling Quebec, where dairy farming is politically and economically foundational. More importantly, Canada had already passed legislation locking supply management into law. This wasn't posturing, it was permanent. Even if Ottawa wanted to concede, it legally couldn't. The demand collapsed on contact. The second demand targeted digital media. Canada's Online Streaming Act and Online News Act require platforms like Netflix, YouTube, and Spotify to invest in Canadian content and compensate local publishers. Washington called this discrimination against American tech firms. Canada called it survival. Without these rules, domestic journalism and cultural production would be buried by algorithms optimized for global scale, not national voices. Carney's message was blunt. Cultural sovereignty is not a bargaining chip. Handing control of Canada's media ecosystem to foreign platforms would mean surrendering influence over its own public conversation. That refusal wasn't economic, it was existential. The third demand focused on alcohol. Several Canadian provinces had pulled American beer and wine from shelves in response to U.S. tariffs on Canadian goods. Washington demanded those bans be lifted. What it ignored was cause and effect. The bans came after the tariffs. Remove the tariffs and the shelves reopen. The U.S. instead asked Canada to abandon its retaliation, while American penalties remained in place. That wasn't negotiation, it was asymmetry. Ottawa declined. The fourth demand involved government procurement. Washington accused Canadian provinces of favoring domestic suppliers for public contracts. The argument rang hollow. The United States aggressively enforces Buy American rules across infrastructure, defense, and manufacturing. Asking Canada to dismantle policies that the U.S. itself relies on daily wasn't a serious proposal. It was leverage testing. Carney treated it as such. The fifth demand centered on energy. Concerns were raised about Alberta's electricity grid and alleged favoritism toward in-province generation. The claim didn't hold up. More importantly, it ignored the broader energy reality. The United States imports roughly 4 million barrels of Canadian crude oil every single day. Nearly a quarter of American refinery feedstock comes from Canada. Entire refinery systems along the Gulf Coast were built to process Canadian heavy crude. During winter peaks, New England relies on Canadian electricity to keep homes heated. Energy doesn't flow north to south out of goodwill. It flows because the U.S. economy depends on it. Here's what most commentary misses. These demands weren't signs of American strength. They were signals of dependency. Each one revealed pressure points inside the U.S. economy. Dairy access exposed how much American farmers rely on Canadian consumers. Digital complaints revealed billions in lost revenue for U.S. tech companies under Canadian investment rules. Procurement pressure highlighted how effectively Canada has been keeping capital at home. None of these demands targeted weak sectors. They targeted systems that were working. And then there was what wasn't mentioned: automobiles. The silence was deafening. North America's auto industry doesn't function along national lines. It's a single integrated system. Parts cross borders multiple times before a vehicle reaches a showroom. Canadian factories produce components for American trucks. U.S. plants manufacture engines for Canadian sedans. Executives from companies like General Motors have warned Congress that breaking this system would be catastrophic. When Section 232 tariffs were imposed on steel and autos, they disrupted the very network American manufacturers rely on. Today, those same manufacturers are among the strongest advocates for preserving the agreement. Carney understands this. Autos are Canada's quiet leverage. If the agreement fractures, U.S. manufacturers feel the impact first. Then came the move that truly unsettled Washington. Carney went to Beijing, not to sign a sweeping free trade agreement, but to secure targeted tariff relief for Canadian agriculture, including canola. This wasn't alignment, it was diversification. At first, Donald Trump praised the effort. Days later, he reversed course and threatened massive tariffs if Canada became a conduit for Chinese goods. Carney responded immediately. There was no free trade deal, no violation of existing clauses. Trade Minister Dominic LeBlanc confirmed the details directly with Greer, who acknowledged the explanation. The significance wasn't China, it was choice. Canada demonstrated it wasn't trapped. As the review deadline approaches, 3 paths remain. The agreement could be extended, either side could withdraw, or annual reviews could begin, creating rolling uncertainty. Many assume Canada will eventually concede because risk feels dangerous, but that assumption belongs to an earlier era. 5 years ago, nearly 3/4 of Canadian exports went to the United States. Today, diversification is tangible. Agricultural exports have alternative markets. European partnerships are expanding. Domestic procurement policies are redirecting tens of billions into local industries. Canada's critical minerals are now essential to U.S. clean energy and AI ambitions. These shifts didn't exist before. They changed the math. Uncertainty cuts both ways. Nearly 150 American industry leaders have warned Congress that the agreement must continue. Steel producers, automakers, energy firms, farmers. They're watching Ottawa stand firm while hoping Washington adjusts course. Before the demands were even public, Carney delivered a speech at the World Economic Forum in Davos that reframed the issue entirely. He warned that middle powers must never accept economic subordination. Countries not seated at the table, he said, end up on the menu. European leaders praised the message. Analysts called it one of the most consequential speeches by a Canadian leader in decades. Washington's response revealed contradictions. Trump dismissed the agreement as irrelevant, yet Greer testified that U.S. exports under it had surged dramatically. No administration spends months outlining conditions for a deal it believes has no value. The posture suggested dominance. The result elevated Canada. Each refusal made Carney look steadier. Each demand looked more like pressure than partnership. Behind the scenes, Canada kept building. Agricultural access widened, alliances deepened, critical mineral strategies advanced, provinces aligned with federal priorities. While Washington postured, Ottawa diversified. Every threat accelerated independence. Every demand justified another alternative. By the time this review concludes, Canada won't arrive empty-handed. 5 demands, 5 refusals, and a country less dependent on the United States than at any point in half a century. The uncomfortable truth is this: the United States needs this agreement more than it admits. Its factories, farms, refineries, and supply chains depend on it. Canada no longer needs it on Washington's terms. Trump entered this expecting Canada to bend. Instead, Canada forced Washington to confront a reality it wasn't prepared for. Power in North America no longer flows in one direction. And this trade review may be remembered as the moment that became impossible to ignore. This moment will be remembered either as a missed opportunity or as the point where North America quietly recalibrated power. Canada has shown it can say no and keep moving forward. The question now is whether Washington adjusts to that reality or pushes harder and accelerates the very shift it's trying to stop. History tends to favor those who adapt first. Where do you think this goes from here? Drop your thoughts in the comments. And if you want analysis that stays focused on what actually matters, not what trends, subscribe and turn on notifications. This isn't the end of the story, it's the turning point.